Friends, over the past week the front pages of global financial media have basically been hijacked by one name, Michael Burry. The guy who went one-on-one with Wall Street in 2008 and became a legend after The Big Short. He's back. The headlines are getting more dramatic by the minute. Big Short drops $1.6 billion to short AI. Burry puts everything on the line, betting NVIDIA will collapse, madman or genius. Burry declares war on AI. Reading those headlines, you might think the man's lost his mind. In 2026, when AI is king, who goes and throws their body in front of the train? If you really believe those headlines, you've got classic retail investor thinking. As someone who's been scraping and clawing through this capital jungle for 2 decades, I've got to come out right away and do a financial forensic autopsy for you. Here's the truth, the media's lying or they simply don't understand derivatives. That $1.6 billion they keep shouting is just a scary-sounding notional number meant to spook non-experts. According to Burry's Sec 13F filings, he doesn't actually hold $1.6 billion in naked short stop positions, he holds put options. How big of a difference is that? Think of it this way, you buy a lottery ticket for a jackpot that's $1 billion. Are you going to brag, I just spent $1 billion on a project today? No. You say, I spent $2 on a shot at getting rich. In this story the $1.6 billion is the lottery's top prize. The actual cash Burry pulled out of his pocket, the options premium, is probably only on the order of about $10 million. See the distinction? Burry isn't crazy, and he hasn't put his life savings on the line. He's put a small part of the funds he manages, roughly 1% to 2%, into a doomsday insurance policy against an AI bubble. In financial engineering terms, that's a perfect asymmetric bet. Why is this asymmetry beautiful? Limited downside, worst case, NVIDIA keeps ripping higher and Burry's options expire worthless. His loss is capped at that $10 million premium. For him, that's pocket change and maybe the price of a couple fewer Lambos. And limited upside, if the AI bubble bursts like the dot-com crash, and prices get cut in half or worse. That option explodes in value by hundreds or thousands of times. That's a $1 billion payoff. That's the difference between a gambler and a hunter. Gamblers bet their lives, hunters place wagers. He is risking a finite amount of chips to capture a mathematically favorable chance at an enormous payout. So stop parroting the Big Short suicide headlines. This isn't suicide, it's textbook low-cost financial hunting. But knowing option structure isn't enough. We need to understand his hit list. If you study Burry's past, you'll see he's evolved. Back in 2013 he tried shorting AI by betting against a basket of semiconductor ETFs. What happened? The market taught him a lesson. That was the eve of the AI boom. Too much noise. Too broad a scope. And the trade got crushed by beta. That was carpet bombing, right direction, but hurting yourself in the process. Fast forward to 2026, Burry learned from that blood. He's no longer shorting the whole sector or fighting the AI revolution at large. He's gone too. Targeted takedowns. His strategy this time is for words, weed out the fake. Open his position sheet, and you'll find a counterintuitive detail. While the media's eyes are fixed on NVIDIA, Burry's short position on Palantir in notional terms is actually heavier. You could even call Palantir his top prey. Why? Because under Burry's microscope, these two companies show completely different pathologies. Palantir is a strategic short. He thinks Palantir is a fake tech giant wearing AI like a costume. It tells the sexiest AI stories, but actually runs miserable outsourcing work. Its business model is fundamentally flawed, a classic business model mismatch. NVIDIA is a tactical short. He doesn't deny NVIDIA's tech brilliance. He doubts the quality of some of NVIDIA's accounting and worries that expectations are way overheated. Get that difference? Burry isn't rejecting AI as a technology. He may be more bullish on AI's future than most of us. What he is rejecting are the fake giants riding the AI banner and the inflated boom pumped up by Wall Street accounting tricks. This is a surgical financial strike. He's not cutting out the heart. He's cutting out the tumor that's metastasizing. So how sharp is his scalpel? What exactly did he find on Palantir that lets him bet heavily it will collapse? And what accounting holes did he find in NVIDIA that make him willing to challenge the market as crown jewel? Next, we get into the most exciting section, the business model autopsy. I'll take you, forensic style, layer by layer through Palantir's glittering AI big data void and show you the skeleton labeled high-end labor outsourcing. Ready? We're diving deep. Let's start with Burry's number one prey, Palantir. In the AI craze, the company was turned into a god. It has Silicon Valley's mysterious legend, works with the CIA and the Pentagon, and claims that once its systems are installed you can use AI to predict the future, catch terrorists, etc. Sounds sexy, right? Capital markets bought that story. Wall Street handed it a SaaS-style valuation. What's a SaaS valuation? That's the kind reserved for Microsoft or Adobe software with near zero marginal costs. Write code once, selling to one client costs the same as selling to a billion. It's a printing press for cash, but Burry, as financial forensic analyst, peered through the microscope and found something off. This isn't software selling, this is a high-tech contractor. Burry's short thesis is brutal. Palantir's skin is AI. But its bones are consulting. Look at the business. Palantir is heavily reliant on government contracts. Government projects are never solved by handing someone an account and walking away. Each project requires Palantir to send a bunch of engineers on site for deep custom work tuning and maintenance. What does that imply? It implies scale doesn't scale. Microsoft can sell Office to another user with almost no extra marginal cost. Palantir signs another big contract and it has to hire a fresh batch of pricey engineers. Its revenue growth is driven by adding heads, not by software leverage. This isn't Microsoft. It's IBM and Armor or a fancy Accenture. If it's really a consulting firm, then its sky-high revenue multiples are a massive valuation bubble. Burry's logic: if you're selling labor, value it like labor, don't pretend you're licensing code and collect a premium. If business model identity is identity fraud. Burry's next cut goes for the main conduit of value extraction, the shareholder dilution via SBC. Burry found that while Palantir's revenue looks like it's growing, the quality of that profit is terrible. Where's the cash going? Into management pockets. Palantir is infamous for being extraordinarily generous to executives, not in cash wages, which look normal, but in huge stock-based compensation. That's a classic cover-up. Stock grants don't use current cash flow. So reported cash flow looks healthy. But where do those shares come from? They're newly issued. It's like a central bank printing money. The company keeps issuing stock to pay executives, which steadily dilutes ordinary shareholders. That's a legal siphon. Retail money flows in and instead of funding R&D for real AI, it funnels to executives through SBC, a company that is being bled by management like that, whereas the internal growth engine. Burry believes games like this, designed to paper over profit shortfalls, can't last. So the conclusion is harsh. Strip off the AI myth and you get Palantir as a slow growth, government outsourcing, exec cash out consultancy. What's it really worth? Burry's short target price is merciless. He thinks Palantir is completely detached from gravity. Based on its true business nature, its fair value isn't $180, it's $50. What does that mean? In Burry's crosshairs, this stock could fall over 70%. That's the conviction behind his heavy shorting of Palantir. He's not betting on AI's failure, he's betting on common sense returning. When the tide goes out, the predict the future crystal ball will be exposed as a labor-heavy outsourcing crew. After dissecting the fake giant, we move to challenge the true god NVIDIA. How does Burry find a financial weak point in a genuinely brilliant company? Did he discover a circular trading capital perpetual motion machine? Let's get into the accounting magic expose. Now we turn the scalpel on the real star of NVIDIA. Some will ask, lelwo. NVIDIA's tech is incredible, and they own 90% of compute. How can you short them? You can, because great tech doesn't equal flawless accounting. Burry smelled a familiar odor in NVIDIA's books, the same smell Enron and Lev once had. It's the market's most dangerous financial alchemy, circular trading. What does that mean? Look at how NVIDIA creates revenue. Burry posted a Bloomberg-style graphic on Twitter, showing a shocking loop. NVIDIA invests in a bunch of cloud startup companies, gives those startups then use that capital to buy NVIDIA GPS and mass gives the money flows back to NVIDIA's books as revenue. See the problem? It's like I lend you money and you use it to buy my stuff. On paper, my product sold, your assets went up, GDP looks good. But in reality, cash is just rotating in a loop. There aren't genuine end customers paying for compute. It's a boost maintained by self-funding. Burry argues that once funding conditions tighten and startups can't raise the next round, that perpetual motion stops. Suddenly those chips become inventory bombs. If circular trading is the inflow trick, the next trick is the expense shift. Burry found NVIDIA's big customers are engaging in accounting sleight of hand. Under accounting rules, servers must be depreciated. Historically, servers depreciate over 3 years. But to prettify AI margins and hide extreme compute costs, the industry quietly extended server depreciation to 5 or even 6 years. What's that mean? Under Moore's law, a 3-year-old AI chip is basically waste today. Would you still run a current H100 in 6 years? Unlikely, but by stretching depreciation, annual depreciation expenses gives reported profits jump. It's legitimate accounting. But it has a cosmetic trick that hides a harsh reality. AI's cost-to-benefit ratio may not be as rosy as everyone claims. Burry sees the current boom as paid for by borrowing depreciation from future years. Finally, Burry delivers the knockout macro falsification. If AI truly were the fourth industrial revolution and foundational, cloud revenues should be exploding exponentially. But the data tells the truth. Burry points out that comparing 2018 to 2022 to 2023 to 2025, global cloud growth has not accelerated, it's slowed. That's counterintuitive. Everyone's buying shovels, yet nobody's digging for gold. It signals that real AI demand lags behind the hardware arms race. The current trillion-dollar market caps are fueled more by because others are buying. I must buy to FOMO than by genuine commercial returns. That is the core of Burry's NVIDIA short. He is not betting that NVIDIA's tech fails, he is betting on financial gravity. When circular trading stalls, depreciation tricks unravel, and cloud growth is disproven, the stock's lofty price will fall back to earth. After dissecting these depre, you might ask, okay, I get the logic, but why did Burry deregister his fund? Is that him quitting and running away? No. As I said at the top, this is an asymmetric war. Closing the fund isn't surrender, it's a repositioning. Do you know what's the hardest part of being a hedge fund manager? It's not losing money, it's dealing with your money, people. When you're shorting AI, your LPs call you every day, Michael. Why did our neighbor make 50% on NVIDIA and you're losing? Are you senile? You don't just endure criticism. You also face tedious SEC compliance and every trade scrutinized under a microscope. Those institutional shackles are deadly for a hunter who needs absolute calm and authoritarian control to execute contrarian plays. So Burry made a brutally straightforward decision. He gave the money back. I am done serving you. He deregistered his fund to reclaim 100% control of his will. He doesn't have to explain why Palantir should be $50 to anyone. He answers only to his own judgment. That's deinstitutionalization, the final move to free himself before launching the final assault. And don't assume he's left the money game. Burry's pivot to selling his knowledge is actually a brilliant forward-looking business move. Do the math. He used to manage $150 to $100 million and earned a 2% management fee. That's roughly $3 million a year. Now, he's writing on Substack at $379 a year. Even a few thousand paid subscribers gives him similar income without having to answer to anyone. But revenue is secondary. His main aim is to weaponize influence. The 2021 GameStop saga taught Burry a lesson about 2026's market nature. Pricing power isn't solely held by Goldman or Morgan anymore, it is held by attention. He learned from GameStop's mistakes. Back then he was a lone pioneer who got the thesis right but got crushed by retail. Now he's smarter. If you can't beat them, join them and lead them. He's building a community on Substack of 180,000 subscribers who pay and buy into his logic. Those 180K aren't a rabble, they're his cultivated short guard. When he blasts a treatise on Palantir's overvaluation, these 180K will be the first wave of spreaders and executors. He isn't trying to convince Wall Street anymore. He's mobilizing retail to attack inflated valuations. It's a new playbook, populist finance. Before, big banks released research that moved markets. Now Cole's post on X and moved markets. Burry is shifting financial discourse from Wall Street boardrooms to internet comment threads. So don't mock his registration. He's more dangerous and freer than ever. He holds two weapons, a left hand of asymmetric options, and a right hand of high-velocity influence. That's the 2026 version of the Big Short. He's not fighting alone. He's launching a people's war on the AI bubble. So what should ordinary investors do who don't want to miss out on AI but also don't want to be vaporized by a bubble? Should you follow Burry and buy puts? Or sell everything and run? Next I'll boil down practical defensive moves you can actually use. This isn't just gossip, it's a wallet survival guide. We're near the end of this deep teardown. If you've stuck with me so far, I believe you now see Burry as short on AI with far more clarity than 99% of market noise out there. Finally, what should regular investors do? Should you short alongside Burry or clear out of AI? Not so fast. Before you act, you must undergo a cognitive reboot. Understand this, every tech-driven bull market has a dual personality. Personality number one is the tech bull, real and true. AI is changing the world, and NVIDIA chips are in short supply. That's the real tech story. Personality number two is the financial bubble, also real. Even great tech can be priced to hope 10 years of growth into today. If the filings are full of circular trades and accounting tricks, it's a bubble. The two aren't mutually exclusive. Like the 2000.com bubble, the internet changed everything. But that didn't mean slapping on anything made it worth billions. Burry's move isn't denying the first personality, he's hunting the second. He's not shorting AI's future. He's shorting the lies preying on investors wearing AI's skin. So here is my first practical tip. Don't equate bullish on AI with brainlessly buying AI stocks. Great companies can have watered-down financials. Great sectors can harbor lethal valuations. In 2026, blind faith is more dangerous than missing a trade. So practically, what should you do? Many fans ask, should I short Palantir via borrowed shares? Absolutely not. That's the classic retail trap, naked shorting. Short selling carries unlimited risk. If retail squeezes Palantir higher to $300, your position blows up and you could owe huge debts. We learn from Burry's form, but more importantly from his spirit. What's his spirit? Asymmetric bets, limited loss, unlimited gain. For ordinary investors holding lots of AI stocks but worried about financial bombs, the best move isn't selling everything, it is learning Burry's play. Buy some protective puts, manage position size, Only use 1% to 2% of your total assets to buy far-dated, out-of-the-money put options. What's that called? An anti-fragile allocation. Treat it like fire insurance for your account. If AI keeps going up, that 1% premium is a sunk cost. You still make money on the remaining 99% and keep your nerves. If AI collapses like Burry fears, that 1% option could go 100x and cover your losses, maybe even make you rich. That's Burry's ultimate defense. Don't gamble. Hedge. I'll leave you with one line. Wall Street has a saying, in the short run, the market is a voting machine. In the long run, it's a weighing machine. Right now the AI market is a crazy voting machine. Stock prices are set by Jensen Huang's leather jacket, TED Talk swagger, retail fervor, and FOMO. In that world, Burry looks like a clown, a loser who's always wrong. But remember, give it enough time and the market will turn into a cold, indifferent weighing machine. What ultimately decides fate won't be a slide deck, it's cash flow, ROI, depreciation, and real profit. That's financial gravity. It may be late, but it always shows up. Michael Burry is the watchman who reminds us gravity exists. With a $1 billion notional position, he rang the midnight bell during this raucous party. You don't have to fully agree with him, but you can't ignore him. In markets, those who can hear the harsh truth tend to live longest. I'm Iron Bull Finance. In this noisy AI era, keep a cool head and read the footnotes. See you next time.